The biggest surprise about banks isn't that they charge fees, it's that many of the ways they make money happen so quietly that most people never notice. You might think you're simply depositing a paycheck, swiping a debit card, or paying off a credit card bill. But behind every one of those everyday actions, there's a business model designed to generate profit. And here's the interesting part. By the end of this video, you'll know which habit quietly earns banks the most money. And it's probably something millions of people do every single month without thinking twice. Banks are some of the most profitable businesses in the world, but they aren't making billions because people deposit money. They're making billions because they know how to put your money to work while charging for convenience, borrowing, and even small financial mistakes. Once you understand how this system works, you'll start making smarter financial decisions without changing your entire lifestyle. Let's start with the most obvious one, lending. Imagine you deposit $5,000 into your savings account. You might earn less than 1% in annual interest, depending on the account. That doesn't sound like much because it isn't. But the bank doesn't leave your money sitting in a vault. It uses deposits from thousands or even millions of customers to make loans for homes, cars, businesses, and credit cards. Now imagine someone borrows money for a car loan at 7% interest, while you're earning less than 1% on your savings. That difference is called the interest spread, and it's one of the biggest ways banks make money. Multiply that by millions of loans, and suddenly those small percentages turn into enormous profits. But lending is only part of the story. Credit cards are where things get even more interesting. Every time someone carries a credit card balance instead of paying it off in full, interest starts building. And unlike many other loans, credit card interest rates can easily climb above 20%. Picture buying a $2,000 TV and deciding to make only the minimum payment each month. It feels affordable at first, but over time, you could end up paying hundreds or even thousands of dollars in interest. That's money flowing straight to the bank simply because the balance stayed unpaid. Here's the twist. Banks actually love customers who always make their payments on time, but not necessarily the ones who pay their balance in full every month. People who carry balances responsibly often generate much more profit over time. Now here's something many people never think about. Every time you swipe your credit or debit card at a grocery store, coffee shop, or online retailer, the merchant usually pays a small transaction fee to process that payment. It might only be a tiny percentage of each purchase, but think about how many card transactions happen every second across the United States, Canada, the UK, and Australia. A $2 cup of coffee, a $50 grocery trip, a $100 online order. Those tiny fees add up into billions of dollars every year. That's why banks encourage digital payments so heavily. The more you use your card, the more opportunities they have to earn revenue. But it doesn't stop there. Banks also make money from fees, and many of them are easy to avoid if you know they exist. Overdraft fees, monthly maintenance fees, ATM fees, late payment fees, foreign transaction fees, wire transfer fees. Individually, they may seem small. Maybe it's $10 here or $35 there. But across millions of customers, those charges become another major source of income. The good news? Most of these fees are optional. Setting up account alerts, maintaining minimum balances when required, using in-network ATMs, and paying bills on time can help you avoid many of them entirely. There's another strategy almost nobody talks about. Banks earn money by offering financial products beyond checking and savings accounts. Things like mortgages, investment accounts, insurance products, and certificates of deposit often generate additional revenue through interest, management fees, or commissions. Think of it like a supermarket. You may walk in planning to buy bread, but you leave with a full shopping cart. Banks work similarly. They want to become your one-stop financial destination, because the more products you use, the more opportunities they have to earn money. And now we've reached the habit that quietly makes banks some of their most consistent profits. It's paying only the minimum amount on your credit card. It feels safe because you're technically making your payment. Your account stays in good standing, but the remaining balance continues collecting interest month after month. What started as one purchase can quietly become far more expensive than you ever expected. That's exactly why financial experts often recommend paying your statement balance in full whenever possible. It allows you to enjoy the convenience and rewards of a credit card without paying interest. None of this means banks are the enemy. Banks provide valuable services that help people save, invest, buy homes, and build businesses. They're businesses doing exactly what businesses are designed to do: make money. The difference is that once you understand how they make that money, you can decide when the system works for you instead of against you. You can keep more of your income, avoid unnecessary fees, and make choices that help your wealth grow instead of slowly leaking away. So the next time you swipe your card, open a savings account, or borrow money, you'll know what's happening behind the scenes, and that knowledge alone puts you ahead of most people. Before you go, I'm curious, what's one bank fee or money habit that surprised you the most? Let everyone know in the comments, because your experience might help someone else avoid an expensive mistake. If you found this video helpful and want more simple, practical money tips that can help you build wealth one smart decision at a time, make sure to like this video, subscribe, and I'll see you in the next one.